Good morning, all. Just popping through with another update regarding the treasury yields and also the FX markets. So the FX markets that we're focused on this morning is, of course, the US dollar crosses US dollar pairs. Now, we won't always just specifically look at the dollar. Sometimes we look at the pound, sometimes we look at the euro. And we also have the treasury yields. So I'm sure people who are maybe actively and kind of on the screens kind of consistently through the day are hearing a lot of news today, yesterday, and over the last week or two regarding the higher treasury yields. So both in Europe, in the UK, and of course in the US, we're seeing higher treasury yields. Now, what does higher treasury yields actually mean? Okay, so when treasury yields are higher, it means that bond prices are lower and investor demand is fairly subdued. Okay, this means that there is effectively a higher confidence by investors in other asset classes and other investments than the likes of the stock market. So traditionally speaking, then we've talked about it obviously numerous times over the last few weeks that when we have obviously a stronger dollar, we tend to have a higher risk haven, I suppose, affiliation with trading or investor sentiment. So that obviously means that traders, investors are more appropriating their risk and their capital into safer asset classes rather than the more volatile asset classes like your cryptos, like your equity markets, like your tech stocks, etc. So that's tends to be a kind of a clear indicator that not necessarily a recession indicator, but a very, very clear indicator that a risk orientation is hedging out of those riskier asset classes into I suppose your safer asset classes. And today the example that we have for the treasury yields is actually the US 10-year. So in America there's 2 years, there's 10 years, there's 30-year treasury yields. And they actually tend to say when the 2-year has a higher rate than the 10-year, that is a recessionary indicator. Okay. Now just using the 10-year individually, we can see that the 10-year treasury yield is at its highest point of this cycle. So this new cycle that's developed since 2020, we can see it very, very clearly since kind of the lows in 2020, where we're kind of between 0.5 and 1%. The 10-year treasury yield now is way up here at 3.5%. And as we speak, is actually trying to break through that 3.5 level that was rejected way back in June during the summer. So those were the summer highs. Now, when you look at the broader perspective, just to kind of put a bit of relevance on this, we can see that the 10-year treasury yield broke out of this previous consolidation. So this 10-year phase of lower yields has now been broken because we've taken out the 2018 highs, we've taken out the 2013 highs here at around about 3.25%, and we are now testing those highs last seen towards the back end of the banking crisis in 2009. So that banking crisis kind of took place between 2007 2009, and we're getting there. We're not just there fully yet. I think we'd have to see another 0.5% on the 10-year to get up to close to 4%, but we are getting very, very close to this level. And of course, that obviously means that the higher the yields, the lower the confidence in the markets obviously means that, generally speaking, stock markets, you'll have more of a decline, more of a cyclical decline in the stocks because of that. I know obviously people focus on different ones like the S&Ps or the NASDAQ or etc. This is on a broad composition basis. So it's not all of it just focusing on one particular sector, but more broadly the generalized markets as a whole. So it's just important to be kind of relevant to that, particularly when you're like, for those who are maybe trading kind of day trading or even swing trading, it is relevant to maybe have a look at that as well. Just have that in the back of your mind regarding kind of the overall kind of confidence and sentiment, because we obviously look at the economic data like retail sales and consumer confidence and CPIs. So we're all looking at all these economic indicators and pieces of data as kind of to give us some sort of forward guidance. But the yield story is definitely one that has been emerging for the last 2 years, but more specifically over the last kind of 6-8 weeks or so. And of course, that then brings us into the dollar. So with that dollar movement, we're seeing, yeah, fair enough, the dollar is holding this kind of consolidation this week into the FOMC on Wednesday. But when you put some relevance on it, when you put some kind of structure on it, you can see very, very clearly that the yield story, the higher yield story, is very much backed by that higher dollar story. And in fact, where you look at that July bottom that happened last year and where we currently are now, we can see that the markets are well above where they were out of previous consolidation ranges like 2015 and obviously 2020. And we are very much kind of reverting this cyclical trend that we saw through the early noughties, where we went from, I suppose, 145, 150 on the euro dollar right back into kind of the 110s, the teens. And this is kind of the reversion of that again. We're seeing that stronger dollar play out. Dollar is very much kind of battling back from this impulsive move here off the lows. And of course, that's factoring into that sustained heavy dollar. But of course, as day traders, we're not looking at the broader perspective. We are more focused on the shorter ebbs and flows within these markets. And we can see that still playing out. The likes of your 4 hour, the likes of your 1 hour, every new high is met with a pullback, and every new high is met with a pullback. So we are seeing that very, very clearly. But obviously into Wednesday's FOMC, we have got a period of consolidation, because we had that, as we talked about it yesterday, only in passing, we had that massive impulse last week off the CPI, that higher than expected CPI figure. Obviously, the smart money play was playing out very, very nicely, because we can see here on the dollar currency, we rejected the 1 hour bottom down here just under 108. And we had that very, very, very clear, sharp, impulsive move back into this area of liquidity up here between 110 and 110.20. So we mentioned it yesterday as well. Markets tend to be in consolidation kind of 70% of the time. And you can see here that we've had a very, very short impulsive, very, very sharp impulsive move in a very, very short period of time, followed by a well and truly drawn out consolidation into the FOMC. So the markets are very much in a holding pattern now, particularly in some of these FX pairs, not all of them, but some of them, into Wednesday's movement. So we're kind of just looking to see kind of what is the material reaction from the FOMC, from the US dollar in this region here. Okay. And I think that's going to be worth paying a close eye on, really the price action this week, to see how does the dollar react. If the dollar starts to see that impulsive move through that 110.20, then the likelihood is you're going to see that either a sharp wick, in which case it's temporary movement, or if they really prove to be hawkish tomorrow off the back of that FOMC, you're going to see the highs probably taken out, and you're going to see that kind of trend, the existing trend, probably continue to play out as well. So we just need to be kind of aware of that. Now, I'm kind of reading some of analysts' comments this morning. A lot of them are kind of projecting a kind of a softer FOMC tomorrow, that they're looking at saying, well, hold on a minute, we've gone kind of from parity at zero interest rates to 3.25 and expected to be nearly by 4%, 4.25% by the end of the year. So it really just becomes a case of kind of how far and how long are they going to run for. And I suppose the forward guidance now will become equally important to see if this dollar trend is actually going to continue, or if we're going to start to see a reversion in this dollar trend. Are we going to start to see pullbacks in the trend? And if so, then what is the material effect on that? But as we speak this week, euro dollar very much in this consolidation structure. And I'm looking, as an active trader myself, I'm looking very, very consciously to see what is the breakaway element from this region. Okay, is there going to be a more lenient view in terms of pullbacks, or are we going to see that continuation in dollar strength and dollar bulls? Similarly, again in the euro dollar, right? If you're looking at the euro dollar broadly, I know we looked at it yesterday briefly. We had that smart money move, but I suppose the broader trend is still lower lows, lower highs. So we do have to be kind of conscious of that. We had that wick last week into that 102 handle, very, very clear rejection. So that's obviously an area of liquidity as well on the higher time frames. Now, when we look at the shorter time frames, we can see how we've had consolidation. We've taken lows, we've taken highs, we've come back into this region. So this would be, if you're looking at smart money and you see a structure like this where we've stop hunted lows, we've taken the highs, we've flooded back into liquidity area. Generally speaking, that's the type of the move that you'd look for. You'd look for a kind of a continuation higher, because that's effectively saying we've had that buy side imbalance, we've had the mitigation of the area of which was consolidation took place, and now we're obviously looking for that continuation. But with these markets, you just never know. And that's why I suppose it's important to kind of be aware of these fundamentals, because we've seen it last week. I've seen a couple of guys already, in which we're going to be doing risk reviews later this week, how the markets can change very, very quickly. And if you're over leveraged or over risked, particularly in volatile periods like this, you will fail challenges, you will fail fund accounts. And that's not just with us, that's with everyone. And it is important to kind of be aware of that as well. Now, again, I suppose euro dollar from a shorter perspective, lot of consolidation. Okay, a lot of consolidation here. We've even got a short-term consolidation structure. Even if I just kind of highlight the region, we can see it there very, very clearly. Very, very clear consolidation structure. Broke out to the highs, pulls back into this area here. We can see another smart money play here in the shorter time frames, and we've seen that initial impulse. Now we are pulling back again, which suggests that the battle here at parity or close to parity is still ongoing, it's still continuing. So this really area here is going to be structurally important, because if we do break through this area, are we going to obviously try and take these lows way in here at 98 or just underneath 99? Or what's going to be material effect from that? So I suppose it's just all about having clarity, being able to identify the structures, have a clear plan in place, whether it's smart money, supply and demand, price action, fibs, or whether it's a combination of a few different elements collectively. All right. Similarly again with cable. Okay, so cable has broken to new lows again. We found that structured bottom just above 113.50, a fairly consolidated move this morning, given the volatility in these markets. Now, of course, again, there's been rumors this morning that there's going to be a cut in the corporation tax within the UK, which did give the FTSE a temporary boost this morning, and you will see a massive wick forming higher this morning on the FTSE for those who trade that. And that was the rationale for that. Very, very sharp, very, very quick and impulsive. And of course, the cable's not immune to this volatility as well. We've got still the political situation to sort out. And of course, the stronger dollar, the headwinds from that is obviously leading the cable to continually churn lower. And at this point in time, we are seeing this short-term bottom forming here at 113.50, but also this kind of short-term highs, particularly yesterday and this morning, forming around 114.50. And we can see that there. We see that impulsive move yesterday, into initial move this morning at 8 o'clock. And of course, we've seen that unwind. So that initial move looks to be kind of nearly undone on the cable. And now it's a case of, do we come back into these lows again at 113.50, 113.70? And I suppose that's what market participants are now looking for, to see, does these bottoms hold, or are we going to get a material breakthrough and a continuation in that dollar strength accordingly? Now, again, personally speaking, if I'm looking at this now, particularly on the shorter time frames, I wouldn't be looking at buying this cable here, because we've obviously had that impulse this morning on the London Open, and we've had that reversal, that stop hunt, that manipulation that you tend to see in some markets. Very, very clear inverted V move where we had that spike and the price action rolls over. So it's just about kind of being aware of that as well as traders and obviously longer term traders, but also shorter term traders. When we look at USD CAD is quite an interesting one as well, because again, when we look at the higher time frames, we can see particularly the daily and the weekly, how markets have really been reacting to the volatility in the oil prices and stronger and weaker dollar, the very, very hawkish Canadian Bank of Canada, and of course the CPI figures last week, and of course the CPI figures in Canada as well, which are starting to now tick up. So broadly speaking, the Canadian economy is still doing better than the US economy. Now, however, with the waning effects on the oil prices, the commodity market starting to cyclically revert, I mean, from those highs that we saw during the summer, really kind of coming back down to more normalized prices, kind of to where we were at the beginning of the year, that is going to have a negative effect on the Canadian economy, because the Canadians generally have oil as the greatest sectoral output of their economy. Okay, so obviously with weaker oil prices means a weaker Canadian dollar exclusively, and in the broader kind of sense of the markets. Now, of course, with the stronger dollar, we also have to factor in that there was massive consolidation here under this 132 level. 132 seemed to be a nice threshold area, 131 as well, for the last number of weeks, particularly when you look at the weekly, because we had these weekly rejections consistently. We had that impulse, we had the price action pulling back, and then last week we had that weekly dollar push as well, to reaffirm maybe that the likes of the dollar CAD now is going to revert back into something up here between kind of 136 and 138. And that was kind of the more broader viewpoint that I would have had once kind of a close was maintained above 132. Now, however, 2 weeks ago, we didn't get that close above 132, which added a lot of uncertainty. And then, of course, we had that massive push last week in the dollar, which maybe goes to the effect that we are getting that order flow now. We are getting that consolidation, and then we're getting that higher high, higher low, I suppose, that you kind of look for. Now, again, with the dollar CAD, we've had a very, very strong run up from this region of interest that we talked about last week, this 129.50. And we had that really strong breakaway through 130 all the way into 132s almost immediately. And then, of course, we've continued to churn higher through that into the 133. So now we are forming kind of some sort of, I suppose traditional traders would call it a head and shoulders. However, I would be kind of conscious to see how does the price action react here. So will we get maybe one more hunt up here to 134, taking out all of those traditional retail traders, and then maybe start to see a pullback? Let's just wait and see. But at this moment in time, US dollar CAD is faring very, very strong. Is still continuing to push to the upside. We are still creating that order flow. We had consolidation, the next wave higher. So we've got wave one consolidation. We've got a second wave into consolidation. This could be a bit of a reset forming, and we could potentially go for one more wave up here. So it's just important to be aware of all aspects, because the traditional traders will probably look to sell here. And then, of course, if the fundamentals and the liquidity, the order blocks, and of course, like the likes of the volume weighted profiles, the VWAPs, could see the markets try and stop hunt and push through. So just be kind of aware of that as well. That's something that's kind of getting interesting now. And of course, similarly as well on dollar yen. Dollar yen had that massive impulsive move. We talked about it last week. Very, very clear push to the upside. Structurally speaking, price action has just completely blown it out of the water. Now, the only thing that I was kind of looking at last night was the stronger than expected. Where are we? We are looking at the stronger than expected CPIs in Japan. Now, broadly speaking, we can see core nationwide CPI was expected, or previous figure was 2.4. And we are seeing the Japanese CPIs continue to tick up so gradually. So all the intervention by the Bank of Japan, factoring in with higher than expected rates in terms of the CPI level, the inflation level, means that the markets now are maybe starting to revert, maybe starting to show some sort of changes in terms of its cyclical nature. Okay, and that's obviously something that we focus and we look at almost on a daily basis, being able to kind of keep an eye on the CPI levels, the current inflation levels, relevant to, I suppose, what's happening in the broader markets. Okay, and that's obviously something as well when we look at here dollar yen. We're seeing those massive moves, those massive impulsive moves, but the trend is still holding out. Now, we did hear last week the commentary coming in from the BOJ stating that obviously they're looking to try and cap, they're looking to try and get involved to kind of bring the moves against the yen back into kind of more realistic levels. So we've obviously seen dollar yen go from 110 to 145 and all across the other currencies as well. It's not a case of seeing if there's going to be an unwind in that. At this moment in time, a higher time frame trend is still very much bullish. Shorter time frame trend, we are creating a temporary area of interest here between kind of 145 back into this area here into 143.50. So I suppose that becomes the area now to see if there's any sort of a battle. So the likes of the battle that's currently taking place here on euro yen or euro dollar, is that going to now be witnessed on the likes of the dollar yen? Okay, and that's going to be an interesting one now over the coming weeks and obviously months as we end the year. So Japan CPI, I suppose the key kind of takeaway from Japan CPI is that it did hit an 8-year high yesterday, which is obviously showing signs that the broader CPI that we're seeing globally is now starting to factor into the Japanese economy as well. So structurally, lower timeframes, if we're bringing it back into lower timeframes, we are seeing consolidation again this week on dollar yen. We're starting to see that impulse again this morning. Let's just wait and see if does that become sustained. If it becomes sustained, you're probably going to get a revision of these highs way up here. 144.70, 144.80 is an area of interest to keep an eye on. Dollar Swiss, now just to kind of round out the last couple, dollar Swiss has been very, very choppy, very, very volatile over the last few weeks, and that's again because of the strength in the Swiss, and the strength of the dollar, the reversions back and forth. Now, this week we are getting a Swiss central bank meeting. Okay, so we've got the Fed this week, we've got Bank of England, we've got the Swedish central bank as well, and we've got the Swiss National Bank as well. So the Swiss National Bank, the Swedes, and the Fed is all looking for 75 basis point increases, where the Bank of England is looking at only 50. Now, of course, whether Will they try and match the other three compatriots and go 75 as well? Still a little bit of time yet to be seen. But if you're looking at the structure here, you're seeing, well, we've obviously got that top formation. We've seen structured lows, lower highs. We've seen equalize here at 98.50, and we had that rundown all into this level here around 95. Now, traditional retail traders will say, oh, there's an inverted head and shoulders, and let's buy this, and it'll go back into this neckline up here at 98.50, and then it'll go into the highs at 100.50 or the appropriate highs. I think there's more to look at than just that. Now, yeah, I do like the idea that the structure there is in place. We've had a nice V-shaped recovery, obviously, last week. If you look at the 1 hour price action, you're seeing that as well. We've got that kind of grind higher. We've got that pullback again. Then we have the continuated impulse move to create new highs again. And then this morning, markets are holding above 96. So I suppose this area here between, I suppose, 95.80 and 96.20 is going to be key into tomorrow's FOMC to see, does this hold up? If we do see that bullish dollar tomorrow, the likelihood is then you're going to see that pick up, creating new bullish order flow and trying to get back into this 98.50 level. But I suppose the higher time frames as well, very, very choppy markets at the minute, but interesting markets nonetheless. So I suppose the invalidation then on the downside becomes, well, if we break through the structured lows, then you could also see the revision back into the downside as well. And at this moment in time, markets very, very choppy here in some of these FX pairs. Now, last two is our specific pairs, which is the Aussie and the Kiwi. Now, the Aussie and the Kiwi, normally speaking, are quite correlated in terms of how they move. However, the only two things that I would say, there's slight differentials in terms of the Aussie in comparison to the Kiwi. The Kiwi has been at or close to the lows from July, whereas the Kiwi has continued to break through that. So the Kiwi has performed a lot weaker than the Aussie in that sense. So the Aussie very much kind of holding at or close to this region here. We can see how the Kiwi has completely unwound, and that 59 target that we talked about last week over here, this daily region here, has now been met and has now been mitigated. So the bearish order flow here we talked about last week, this kind of lower low, lower high, lower low, lower high, mitigation of area or close to it, 64.75. And then, of course, the new lows below 62, obviously confirmed, dead cat bounce recovery. And then, of course, the markets have continued to sell off right into 59. So those kind of points we talked about last week are playing out pretty cleanly. Markets are moving fairly clearly overall. And the order flow in the Kiwi dollar, NZD/USD, is still very much bearish, very, very much bearish. And of course, now we've gone from very, very sharp decline, and we're starting to see that gradual kind of move now. So you tend to see initial impulse, and then you tend to see this type of move playing out. And then we tend to look for that reversal, pullback, and then bullish trend starts to take hold. So we've got that impulse. We're now starting to see the bearish order flow, these lower lows, lower highs coming through. Now we just need to see if there's any sort of snapback taking out some of this order flow. At this moment in time, we are still kind of bearish. So for me personally, like I kind of drew out there, when we kind of get that snapback, I tend to look for a break of lower highs, break of some sort of high structure, mitigation, flagging back down into the region to clear out the rest of the liquidity, and then obviously impulsing back up accordingly. So that's generally what I look for myself. So at this moment in time, that's still very, very early days in terms of how that one's developing. And of course, the Aussie in comparison, obviously still creating bearish order flow because we've got the lower lows, we've got lower lows, we've got lower highs, we've got lower highs. We've short-term lower highs here as well. We've got a rejection here. We have another one here at 69. And then, of course, we've now come back into this region around 67. So in comparison to the Kiwi, which is at 59, the Aussie is doing a lot better and is holding this area around 67. So you can see here very, very clearly, kind of just draw it out. Area of interest, retest of lows, impulse to create another lower high, retest of these current lows, short kind of dead cat bounce recovery. So a dead cat bounce recovery is a very, very short bullish recovery. And then, of course, we've broken through. So we've broken through the structured lows, close below, retesting now. Is this going to become a case of a simple price action where the current supported level turns to resistance, and then we see that market ultimately unwind, engulf these current short-term lows, and then continue declining? I suppose that would be the option there. But given this morning's moves, particularly here, if I just remove this level for a second and we isolate the price action here, we can see very, very clearly short-term bottom. We've breached the bottom. We've flagged back up. And of course, what have we rejected? The last buying candle before that sell breakout has now been mitigated and the markets are rejecting. So there was a nice clean selling entry there from this order block area here, the smart money move at 67.45 this morning. And of course, we can see that wick rejection on the 4 hour. That's another confirmation tool. And then, of course, that follow up with that bearish move now. So it looks like the bears are going to be back in control. I would suspect that it's going to try and test these lows at 66.70. But then it becomes a case of, well, if the dollar is going to remain strong, it should try and take out these lows and continue trailing lower. And then, of course, it brings in the downside targets, 64.50, 65, and maybe even 66 as a shorter term level of interest. So there's some interesting moves there developing on the Aussie there as well. So that's pretty much it. Just wanted to kind of look at some of sort of different asset classes this morning for the video, just to kind of look at how all of these different asset classes work in tandem with each other. And of course, the movements with the FOMC tomorrow. So tomorrow we have obviously the FOMC. Thursday we do have Bank of England. So we might even look at some of the pound pairs later in the week on Thursday with the Bank of England actually trading on Thursday as well. All right. Thanks everyone. Have a great week.